And welcome everyone to an executive overview of ASUs issued in 2017. The good news is that FASB only issued 15 ASUs last year. That is not the smallest they've ever issued, but it's also not the largest. And so it was a nice happy medium in terms of the number of ASUs. And so what we're going to do over the next 50 minutes is we're going to go over them at a high level. We're not going to dig in deep to all the nitty-gritty aspects of them, but what we're going to try to do is just make you aware of what the background is, what the big changes were, and then what going forward you can think about. But we're not going to go into some heavy detail. For some of the ASUs, we've actually done an in-depth, a separate webinar already for them, and so we'll be able to talk a little bit about that as well. So again, welcome. My name is Melissa Galasso, and I'm a director in the Charlotte office for Cherry Bekaert, and I primarily work with the firm's nonprofit and government clients, although I do every once in a while deal with some of the private companies. I don't do very much with the SEC companies, but I am happy to train everybody. So thank you for joining me today. So your learning objective for today's course is hopefully you should be able at the end of this to list the ASUs that were issued in 2017 as we go into 2018. Now remember, not all of these will be effective even in the next year or so. Some of them are effective many years out. These are just all the ones that were issued. Back in December, we covered all the ones that were effective for December. So we keep those as two separate webinars so we don't confuse people. The ones that were effective we covered in December, and these are all the ones that were issued. So before we dive on in, let's start with our first polling question of the day, just to get a feel for you. What industry does your entity belong to? And we have a few options here. We have not-for-profit, education, government or government contracting, industrial, manufacturing or distribution, real estate or construction, tech, life science or health. Are you a financial institution or other? And if you are other in the chat pod, I'd love to hear what you guys do. So definitely in that chat pod, for those of you who think other is appropriate, I would love for you to let me know what you guys are coming from. Now remember, as we go through this, as long as the black dot is not next to no vote, we have received it. There is no submit button. So long as you have put your information in there and you've selected A through H, we've received your information. There is no submit button. All right, so we've got some medical software, we have a consultant, we have some SAS out there. All right, excellent. Legal, excellent. So lots of different entities joining us today. Let's end that poll, Chrissy, and broadcast the results. So about 45% of you are coming from our nonprofit and government space, which is not unusual. We have a good attendance record with our nonprofits. And then we have about 20% of you coming from other, which again is not uncommon. No, we have some retired and people. That's very brave. I'm not sure if I'm retired. I want to continue to do CPE, so good for you. All right, so a little bit of everyone here today, so excited to be able to chat with all of you. Lots of very cool things going on here, but we've got some legal, some retail, and then a little bit of everything as we go through. So I'm going to go through them literally one by one in the order that they were issued. And we're going to start with ASU 2017-01, which is the definition of a business. And you're probably asking yourself, why on earth does the FASB have to define a business? Well, the reason that they needed to update the definition of business was that the current definition in Topic 805 was being applied too broadly. And some of the transactions that most people felt that were really akin to an asset acquisition were being treated as business acquisitions because of how broad the definition of a business was. And so because of that, they wanted to take a look at how they could really identify the difference between an asset acquisition and an acquisition that is really a business acquisition. So what did they do? Well, they actually created a the handouts say 2017. Welcome to the fact that the year changes and necessarily my brain doesn't go with it, so I apologize for that. That is too funny. Too funny. All right, so let's talk a little bit about what the update has. So the update does something to, in what we call include a screen. And a screen is when a set is not a business. So it automatically says, okay, let's do this as step one. Let's screen out things that by definition can't be a business. And so the screen was set up that when substantially all of the fair value of the assets that are being acquired or perhaps disposed of, depending on what position you are in the transaction, is concentrated in a single identifiable asset or a group of similar identifiable assets. If that's the case, then by definition, that cannot be a business. So if you are buying something and substantially all of the fair value is coming from a single asset or a group of assets, then that's going to imply that you are not a business. Now, that does not mean that you don't have to do any more work. So a lot of things are going to get through the screen when you're not buying a single identifiable asset. And that is just going to be there to reduce the number of transactions that need more evaluation. So in the next step, if the screen is not met, then they defined a business, and they said in order to be a business, the set must include, at a minimum, an input and a substantive process that create together the ability to create an output. Now, I think this is really interesting. You don't actually have to have an output to be a business. You generally do have one. They're generally there, but it's not required. But now they have to have a substantive process. This also removes the evaluation of whether the market participant could replace any missing elements. That was in the last definition, and that really caused a lot of problems for entities when they were looking at whether something was a business. So they removed that aspect of it, and then they created that substantive process in order to streamline out some asset acquisitions. So this is effective for the upcoming calendar year end 2018 if you are a public business entity, and 2019 for everyone else. So we have a little bit of time here to think about it, but if you are a public business entity, if you're doing any acquisitions during this calendar year, this is something you should be taking into consideration. All right, for all my nonprofits in the room, the next one is for you. ASU 2017-02 is related to clarifying when a nonprofit entity that's a general partner or a limited partner should consolidate a for-profit limited partnership or similar entity. And this was issued back in January of 2017, and it's an amendment to ASU 2015-02. So if you remember, if you attended our webinar back in December, ASU 2015-02 substantially changed the consolidation analysis, and it hit 5 things. 3 of them were related to VIEs, 1 of them was related to an indefinite deferral, and the last one was related to general partnerships. And in ASU 2015-02, they said that there was going to be no specific guidance for general partners or for limited partnerships. Instead, what you were going to have to do is you were going to have to go through the consolidation process to determine who is the appropriate entity who should consolidate. Well, that works great if you're a commercial entity. But the problem is, if you know anything about our consolidation analysis, step 1 in the consolidation analysis actually starts with whether something is a variable interest. Well, nonprofits are scoped out of variable interest entity guidance. And so when they took away this guidance related to limited partnerships, there was no guidance left for nonprofits. They were sent to a section that didn't really apply to them. And so ASU 2015-02 is a response to that issue, and it's specific to not-for-profit entities. And so basically what they did is they took everything that was in topic 810.20 and they lifted it up and they dropped it into subtopic 958.810. And what this effectively does is it brings over the old consolidation guidance regarding limited partnerships and makes it nonprofit specific. So only now nonprofits that are general partners can presume to control a for-profit limited partnership regardless of their ownership, unless obviously the presumptions overcome with kick-out rights or participating rights, et cetera. But now that presumption regarding limited partnerships is now nonprofit specific. In the past, it was a normal section of the process for the codification when you were looking at consolidations. Now, ASU 2017-02 makes that specific to not-for-profit entities. And so for not-for-profits, this is going to be effective basically for last year. And you're probably asking yourself, well, that doesn't help me. Well, the reason why is that, remember, this was issued back in January, and the ASU 2015-02 was effective for last year. And so they wanted you to adopt ASU 2017-02 with ASU 2015-02. So if you're closing your books for December of last year, this is effective for that period. The next one is related to SEC companies. So if you are a public company and you follow SEC guidance, this is for you. So ASU 2017-03 is related to an SEC announcement that was made at an EITF meeting. It was also issued in January. And it's related to 3 standards that came out. So FASB was pretty busy with their 3 big projects. So they issued ASU 2014-09, which created Topic 606 for revenue recognition. They issued ASU 2016-02, which created Topic 842 for leases, and they issued ASU 2016-13, which created Topic 326 on financial instruments, and specifically the credit loss standard, or what we sometimes refer to as the CECL model. Well, those 3 projects were very, very large projects for the FASB, right? Those were our big convergence projects. And if you think about it, if you look legally, the SEC is technically responsible for creating GAAP. Now, they have delegated that to the FASB, but every once in a while, the SEC has specific GAAP that they want for their filers. And if you look in the codification, it's in the S99 section. So there's a special section of the codification for SEC guidance. And one of the things that's in there is related to SAB Topic 11M. And Topic 11M requires that if you're a publicly traded company, you must evaluate ASUs that have not yet been adopted, right? So they're effective in the future. You haven't adopted them yet. But to determine if there's going to be any potential effect on the financial statements when you do adopt them. So basically, you have to tell users, hey, by the way, FASB issued this lease standard, and it's going to have an impact on our company, and then you're supposed to provide enough information. Right? And so if you don't know or you can't estimate that, and then you are expected to then include a statement to that effect that you can't exactly quantify it yet, but you should provide qualitative information to help the reader understand the impact. Well, ASU 2017-03 goes in a little bit detailed and says, hey guys, this is really important. These 3 standards we know is going to have a pretty material impact on entities. And so it said that the SEC staff was going to expect the additional qualitative disclosures to include a description of the effect and a comparison compared to the current accounting policies. So no longer could you keep pushing it off, right? They felt like entities were really not was not really providing enough information. And so a registrant would need to describe the status of its process regarding implementation and any significant implementation matters that have not yet been addressed by the entity. And so what they were really trying to do here was provide information about the quality of the disclosures related to these big 3 that we know are going to impact everyone. Like, nobody's surprised by this. However, it is something that we need to pay close attention to because we know it's going to have an impact. And always telling people that you don't know the impact, the SEC was kind of tired of hearing that. All right, so that brings us to our next polling question. And this polling question is very similar to the one we asked back in December if you attended that webinar, which is if you have an accounting question, where do you go? And if you put in other, I'd love for you to tell me in the chat pod where you go. If you put in the internet, what kind of sources are you using? Are you Googling it? So tell us a little bit about where are you getting your questions answered. And your choices are A, the FASB or GASB website. Oh, we have a lot of Googlers here. AICPA technical hotline. That one's a big one for me. Typically, once I've done my research and I can't figure it out, that's where I go next. An A&A guide. So for those of you who are in, NACUBO is a great one for those of you who are in the education world. The A&A guide, so if you're a government or you're in certain industries that have an A&A guide, that can be really helpful. But I'm happy to see so many of you saying your auditor, right? Your auditor is supposed to be there to help you with this. That's what their value add is. So I love that you're using that as an option here. The internet, many of you are Googling it, so I love to see that. A lot of that CPA firm guidance is up there. See some accounting research manager being used. There's some professional development resource guides out there. I love it. I love it. And then other, and so there's a little bit of everything coming out here, NACUBO being a big one. If you have an industry that has a very active industry-leading organization, very frequently they do provide some pretty good guidance, so that can be great. So let's end that poll, Chrissy, and broadcast those results. And beautiful. So as you can see here, it's a pretty good split. The highest one being the internet, which I'm not surprised by. Google is our dear friend. And then in a close second, the auditor, followed by going directly to the FASB or GASB website. So that's great. I mean, that's really showing that you have a lot of options out there if you're not sure. And let's be honest, it's very hard sometimes, and it takes a lot of time to do research. So it's important to have research skills. And believe it or not, the CPA exam now has a research skill question on 3 out of the 4 sections. So in audit, you have to be able to search the codification, and same thing for the FASB. And then if it's at the regulation section, they have to be able to search the tax code. So they're actually requiring our younger CPAs to actually have these research skills and to be able to go and look things up. So great job, everyone. All right. So let's keep going here. And I know you're not supposed to have favorite ASUs, but I do. I have a couple of favorite ones this year. And ASU 2017-04 is probably one of my personal favorites. And if you look at it, it's relating to the goodwill impairment test. So back in 2014, the FASB provided us, through the Private Company Council, a PCC alternative to amortize goodwill. And a lot of private companies took us up on the option just to amortize their goodwill over 10 years. However, public business entities, our SEC filers, and nonprofit entities were not within the scope of that standard, so they were unable to go through. And so some of them said, hey, I want to amortize my goodwill. And the FASB's like, hold on, we did this, right? So remember, before Statement 142, goodwill was amortized. So when I took intermediate accounting, I learned to amortize goodwill over 40 years, right? That's what I learned in college. And then sometime between graduating from college and getting a job, the FASB changed their mind and started to do this impairment analysis thing. But we used to amortize goodwill. And so they said, we don't want to give up on impairment. We want to continue as much as we can, but maybe we can make it simpler. And so the FASB separated the project into 2 phases. Phase 1 being simplifying how an entity is required to test goodwill. So perhaps we could find a way to make it easier to do goodwill impairment testing. And then in Phase 2, if that doesn't work, then they can look at other options like going and amortizing goodwill. But that wasn't going to be the primary step for them. Now, if you remember, there's currently a 2-step impairment process. Step 1 is to go through and do what we call a potential impairment. So you take the fair value of the reporting unit and you subtract its carrying amount, and then based on that, you're going to calculate what is the value of, is there goodwill impairment, right? So it's a yes or no question. So step 1 just says, is there goodwill impairment? However, it doesn't tell you how much. Then you have to go to step 2, which is the how much. And in step 2, we use what we call an implied goodwill methodology, which means that we go and we re-fair value all of the assets and all of the liabilities, and then we determine based on the price what the value of goodwill should be. And that's the really expensive part, right? So it's expensive to get a valuation, it's expensive to go through that process, and it's time-consuming and it's complex. You typically have to hire someone from outside to do it. And so people really didn't like step 2. And so when they looked at how can we simplify the goodwill impairment test, well, what they decided to do was ultimately just eliminate step 2. Now, it's kind of funny because if you read the basis for conclusions, it actually says that they understand that this is conceptually flawed, meaning that just taking the difference between the carrying amount and the fair value isn't really the true price of, or the true value of the impairment. However, goodwill is a plug, right? Let's think about this. At the end of the day, goodwill is the amount that gets your journal entry to balance. And if you make any changes to any other number in the journal entry, goodwill is what gets the adjustment. And so they said if something is a plug number, how accurate do you have to get a plug number to be? And so by eliminating step 2, they eliminated the need to do that implied goodwill valuation. It removes the need to go through and value all of the assets and liabilities at that point. And so this is a huge win for those entities, and it's going to be a lot cheaper to do your goodwill impairment going forward. And now basically all you're going to do is take that carrying amount and their fair value, and you're going to do the simple subtraction, eliminating the step 2. Now, if you want to do what we call step 0, which is the qualitative assessment, you are absolutely welcome to do that. However, I've had people tell me that Moby Dick took less words to write than writing a qualitative assessment for goodwill, and so now a lot of people don't enjoy that aspect of it, and so this is going to provide them a quantitative, simpler option. All right, and so let's look at the effective date for this. And so as you can see here, for SEC filers, it would be for calendar year ends 2020. If you are a public business entity that is not an SEC filer, so remember, there are 5 reasons why you could be a public business entity. Only one of them is filing with the SEC. There are 4 other things that can make you a public business entity, and one of the big ones is being a conduit debt obligor. And so those entities who aren't SEC filers but are stuck under the definition of a public business entity, they get an extra year. So that would be 2021 for them. And then everyone that is not a public business entity, which includes not-for-profit entities, employee benefit plans, and your typical private companies, they are going to be 2022. And I'm really struggling with saying the word 2022 because that seems so far away. But I know that it's going to come super duper fast. And so it just seems like every year it just flies by. My daughter turned 10 last year, the whole double-digit thing, and that was really hard for me. I just still picture her as my 7-pound, 7-ounce baby and not a 10-year-old with a sassy mouth. So I don't know where time goes, but they are already making effective dates for 2022 if you think about it. So crazy what's going on at the FASB. All right, so that's it for ASU 2017-04. We're going to move on now to 2017-05, and this one is kind of an interesting one. It has an impact in a bunch of different areas. So first off, it is related to derecognition guidance and partial sales of non-financial assets. So that's really the background here. And if you look at it, it was issued back in February of 2017, and it stems back to really ASU 2014-09. Now, when we talk about ASU 2014-09, we typically talk about Topic 606, which is revenue from contracts with customers. However, if you look carefully, in addition to creating Topic 606, ASU 2014-09 also creates subtopic 61020. And so it was issued as part of that overall guidance, and it deals with recognizing gain and loss from the transfer of a non-financial asset in contracts with non-customers. So if you remember, it's revenue from contracts with customers, right? That's what Topic 606 is. But there's a lot of transactions when there's a sale and the other entity is not a customer. And so Topic 610 was created to deal with the gain or loss on sale of a non-financial asset. However, the terms that were used in Topic 610 included the term in substance non-financial asset. So they used that term multiple times in Topic 610, but they didn't define it. And so there were a lot of questions that came up related to ASU 2017-05, that are being addressed in ASU 2017-05 related to that term. So the first thing that they do in ASU 2017-05 is to define what is an in-substance non-financial asset. So in substance, meaning it's not really, but it substantively is a non-financial asset. So what is that? Well, it's a financial asset. The opposite of a non-financial asset is a financial asset. So it's a financial asset that is promised to a counterparty in a contract, and substantially all of the fair value of the assets that are either recognized or unrecognized that are being promised to the counterparty are actually concentrated in the non-financial assets. And so while it looks, and it is, a financial asset, the fair value is being driven by a non-financial asset. And so basically what it says here is that, yes, while it is a financial asset, because the fair value is being driven by these non-financial assets, then what we're going to do is we're going to treat it like a non-financial asset, and therefore, in substance, non-financial assets are actually going to be within the scope of Topic 610, which is typically just for non-financial assets, but these are going to be our in substance non-financial assets. For those of you that are in the recon world, so if you're in construction or predominantly in real estate, there is another piece in here, and I'm not going to go through all the details because you're going to obviously get some recon training, but I wanted to draw attention to the fact that there's something called a partial sale. And partial sales are actually really popular in the real estate world. And so basically what happens is that they transfer a non-financial asset, so say a building, to a counterparty, and as part of the payment, they actually receive a non-controlling interest in the legal entity to which the asset was transferred. So we sold this to another entity, but now we're getting, as part of our payment, ownership in the entity that now owns the building. And so that's called a partial sale. And there is some specific guidance about when you have a partial sale, what do you do? And so basically it transfers control using the same concepts of control that's in Topic 606 for revenue recognition. In the past, we had industry-specific guidance that dealt with this, but now that we've moved to no industry-specific guidance under Topic 606, they needed to sort of clarify how to deal with that. So that is something that you should be aware of there. Because this is addressing the concepts here related to revenue recognition, they are actually going to be effective at the same time as the amendments in ASU 2014-09. So that means that basically it's effective for this year for if you're a public business entity, and you get an extra year if you are a private entity. So basically that's the balance that they have there between them. All right, ASU 2017-06, for those of you who have employee benefit plans, this is related to a master trust agreement. Now, a master trust is a very specific definition for the standard. So this was issued in February of 2017, and it deals with a very specific definition of a master trust. And that is a trust where a regulated financial institution, whether that be a bank or a trust company or some other type of financial institution that's regulated, serves as either a trustee or custodian, and there are assets of more than one plan sponsored, or in which assets of more than one plan sponsored by a single employer or by a group of employers under common control are held. Right? And we're starting to see this as an output of some of the pensions that are out there that are being curtailed. And basically, the ASU is going to address some practice issues that have been seen in the past. And the first one is related to line items. So there are actually multiple sections for employee benefit plans depending on what type of benefit plan it is. And so Topic 960 required that investments in a master trust had to be presented in a single line item in the Statement of Net Assets available for benefits. However, 962 and 965 did not include the same guidance. So that resulted in diversity in practice. Some people analogized what Topic 960 did. Other people said, hey, if it's not required, we're not going to do it. And so basically what this requires now is for each master trust that you hold an interest, you must present it in a separate line item in the Statement of Net Assets available for benefits and in the Statement of Changes in Net Assets available for benefits in the master trust and any change in interest respectively. So again, just requiring that presentation of a separate line item that was required for certain entities but not for everybody. In addition, it also looks at an area of problem related to percentage interest. Topic 960 and 962 used to require plans to disclose their percentage interest in the master trust and provide a list of investments held by the master trust presented by general type within the plan's financial statements. However, stakeholders said that the disclosure was misleading when the plan had a divided interest in the investments of the master trust. And so that was when the plan had a specific rather than a proportionate interest in the master trust. And so there was a lot of confusion regarding the appropriate treatment of that. And so basically it removes the requirement to disclose the percentages if you have a plan with divided interest, and instead requires that all the plan disclose is the dollar amount of their interest in each of the general types, which is going to supplement the existing requirements to disclose the trust balance. So they are cleaning up the disclosure requirements there. In addition, there is some issues related to what we call other assets and liabilities, and these are typically for most entities just a catch-all, right? It's where we kind of dump things in. And current GAAP does not require any disclosures by plans of a master trust regarding the other assets and liabilities. So this could be amounts due from brokers or amounts due to brokers. It also includes things like accrued interest and dividends. And people were saying, hey, that stuff is stuff that I have an interest in, right? So there's no requirement here. So now all plans must disclose their master trust, other assets and liability balances, and the dollar amount of the plan's interest in each of those balances. So they're starting to require a little bit more in terms of the disclosures there. And the last one's related to what we call 401H accounts. And this is a problem with redundancy. So the 401H accounts generally had to provide both the defined benefit pension plan disclosures and the health and welfare benefit plan disclosures. And those were noted to be somewhat redundant, and so it caused unnecessary work. And so ASU 2017-06 removes the redundancy and does not require that you have those investment disclosures related to 401H accounts so long as you are following the health and welfare plan. So because of that, you don't have any redundancy being left there. So they deal with a couple of different things in these master trusts, and this is effective for fiscal years beginning after December 15th of 18, which would be our calendar 2019 year ends. Pensions. Now, I don't know how many of you still have pensions. I work with a lot of governments, and those are raring and busy and active. But I know on the commercial side, we've seen a reduction in pensions just in the commercial area. But for those entities that have pensions, they still are typically a pretty big number on the financial statements. And so this one was really looking at certain disclosures related to pensions and how we were dealing with them. And so if you think about it, when we look at what we call net periodic pension costs, there are 6 components of pension cost. There's your service cost, meaning you worked an additional year, so you're entitled to an additional year of benefit. You have your interest cost, which is if you have a liability, if you're not perfectly funded, you're going to have interest on the liability. You're going to have the actual return on the plan assets. You're going to have gain or losses. You're going to have amortization of what we call prior service cost. This happens if you start a plan after someone's already started working. Or if you were in the initial group that was in the adoption of subtopic 715, it could be the amortization of the transition asset or obligation. And so when we converted to this, some entities had the option to amortize their transition. Theoretically, at this point, there should be almost none of this left, but every once in a while, you'd still see some of it floating around. And so the problem here is there are 6 components of pension costs, but topic 715 does not tell you where it has to go, right? So you can, some people lump it all together in one place, some people spread it out, and there's no requirement to disclose by line item the amount of the benefit of the net pension cost and where it is in the income statement, or if perhaps some of it has been capitalized. And so that has been a big issue for users of these financial statements. So the outcome here is there's going to be some required consistency. Going forward, if you are an employer, you must report just the service cost component in the same line item or line items as your other compensation costs. So wherever you put your wages or your salaries, that's where you're going to also put the service cost component of the pension. However, the other 5 components cannot be lumped into compensation costs. Instead, they are going to be required to be presented outside of your subtotal of income from operations, meaning all the other 5 items are non-operating items, and so they will be below income from operations. And once you do that, you actually, if you're using separate line items, have to identify where they're being stored. Right? So, and if you're not using separate line items, you have to indicate and present them so that people can find where those components are. And finally, if you are capitalizing any compensation, and we do that when if you have internally manufactured inventory or if you have a self-constructed asset. I used to work for a company that would do build-outs within an airport, and we would capitalize the construction people's salary. And so if you are capitalizing that, you can only capitalize the service cost component of the pension. So the other 5 components cannot be capitalized. So if you're going to be doing that, only the ones that are deemed to be compensation can be capitalized. Everything else cannot be. And so this is one of the changes here for those entities. Now, good news is it's going to be prospective if you're dealing with capitalization. It is retrospective for everything else. And so for public business entities, this is for annual periods beginning after December 15, 17, which would be this calendar year, 2018. And if you're everyone else who's not a public business entity, it would be 2019 calendar year ends. All right, 2017-08 deals with an issue related to callable debt. Now, if you think about this, if you have debt that's been it's callable, that means you can call it before it matures. And generally speaking, entities amortize the premium of a debt instrument over the maturity, right, over the contractual life. So just basic freshman accounting, when we teach bonds, for example, when we have a premium, it is amortized using an effective interest rate method from the very first day all the way to the time that it's going to mature. And so we don't consider early payment of principal. So if you are calling the debt, that's not really being included. And so what happens is if you're not considering this early repayment, if you exercise the option to call the debt early when it's at premium, not all the premium has been amortized at that point. So there's a portion that's unamortized premium. In order to get the journal entry to balance, because there's excess on the debt, they actually have to record a loss in earnings for that amount. And so people were not particularly happy with the accounting treatment there. And so under the new standard, we're actually going to shorten the amortization period. If you have a callable debt instrument and it's at a premium, you're now going to amortize the premium to the earliest call date, not until maturity. So if you have a 5-year maturity bond, but you can call it after 2 years, then you're going to amortize the premium over 2 years instead of over the 5. Now, this only applies if you are at a premium and it's callable debt. So if you have a security that is at a discount, that is still going to be amortized to maturity. We're only talking here about callable debt that is at a premium. And so this is going to be effective for 2019 calendar year ends for public business entities and 2020 for everyone else. All right, that brings us to our next polling question. And here we have a fun one. Did you make a New Year's resolution, yes or no? I was going to ask if you were still doing your New Year's resolution, but I thought that would be kind of mean. So I decided to go with, did you make a New Year's resolution? Jonathan has done a lot of studying of this, and he has said that if you're over 40, you're less likely to have a New Year's resolution. And Jonathan, as he told you guys in December, just turned 40, and I am just under 40. And so I did have sort of a New Year's resolution. Instead of having a resolution, I did goal setting, but Jonathan did not, and so we apparently are following the research that Jonathan has read. Now remember, there is no submit button here. So long as that black dot is not next to no vote and it's sitting yes to either yes or no, we have received your response. And so again, yes or no, did you make a New Year's resolution? And it looks like you guys have stopped voting, so we can end that poll and broadcast the results. Now remember, we don't know your ages, so I have no idea, but it looks like about 63% of you did not make a New Year's resolution, while 37% of you did. So apparently we are bucking that concept of a New Year's resolution, and I think that's just fine. All right, let's keep moving along here with ASU 2017-09, which is related to modification accounting. And this is when one word makes all the difference. So if you look at the master glossary and you look up the term modification, it says a change in, and here's the key word, any of the terms or conditions of a share-based payment award. And why is that a problem? Well, some people took any to mean a date, the name of the company, the name of the stock plan, which a lot of other people said, no, that's administrative. That's not a term and condition of the award. That's just an administrative change. And then people would say, no. FASB used the word any. So any change is a modification. And so that drew a lot of people into modification accounting. And so FASB said, we need to fix this diversity in practice. And so the default is that if you make a change, it is a modification unless, and you have to meet all of the following. So if there was no change in the fair value, that means the fair value of the award was the same before the modification as after, and the vesting conditions were the same before and after the modification, and the classification as either equity or liability was the same before and after the modification. So if you didn't change fair value, if you didn't change the vesting conditions, and you didn't change the classification by making this change, then you didn't have to follow modification accounting. And so that's a nice little win here. And this is really looking at those administrative items. The administrative items really are what are not going to qualify as a modification going forward. And so this is effective for all entities in this upcoming calendar 2018 year. 2017-10 is related to the customer in an operating service agreement. So why is this important? Well, this has to do with revenue recognition. And this is related to when we have a service concession arrangement. This is sometimes called a public-private partnership. And so the rationale behind this is if you are a public entity, and not a public entity meaning a public business entity, but like a government, and you don't want to operate something that you own. So for example, a road. You're going to make a toll road, you own the road, but you don't want to have to operate the toll booth on the road. And so what happens in the service concession arrangement is that the grantor has an operating entity, and the operating entity operates the grantor's infrastructure. And so the question that came up in topic 853, which is for service concession arrangements, is who is going to be the customer? Because if you think about it, let's just use a toll road for example. In this agreement, under topic 843, the grantor, the government, has the ability to modify or approve the services, who receives the benefit, and at what price. So they have control over the amount that's being charged in the toll booth. They continue to have a residual interest in the infrastructure as well. And so the question was, is the government is the customer, because that's who you have the contract with and that's who determines the amount of the pricing, or is it the drivers on the toll booth who are actually making payment, right? So they are the ones who are paying you to drive on the toll road. And that was the question that was posed. And this is obviously really important for topic 606 because you have to know who is the customer in order to be under topic 606, which is revenue from contracts with customers. You need to know who is your customer. And so it tells us that the grantor is the customer in all cases for a service concession arrangement that's under topic 853. That means the government in all cases will always be the customer, and it will never be the third-party drivers who are the customer in a service concession arrangement. So that's a very finite answer to a very fluffy question. So obviously this has to deal with if you have adopted topic 606 or not. If you did early adopt topic 606, obviously you need time to adopt this, so they gave an extra year, so 2017 and 2018. If you have not adopted, then you're just going to follow the effective dates for your transition to topic 606. 2017-11 is another one that I have a great affinity for. I don't work with a lot of public companies. As I said, I work primarily with private companies, governments, and nonprofits. But one day something came to the help desk, which I work for Bekaert, and it was related to a down round feature for a public company. It was probably the hardest thing I've ever worked on in my entire life. And I'm not going to go through all the details of down round features. But there's really specific guidance in current GAAP where you have an equity-linked financial instrument that has a down round feature, and it determines whether it's going to be classified as a liability or an equity instrument. And it goes back to looking at the definition of a derivative. And one of the things to qualify for a scope exception from derivative accounting is whether something is indexed to its own stock. And in the rules today, if you have a down round feature, then you're not considered to be indexed to your own stock, which leads you to be treated as a liability that has to be at fair value. And people have complained. They said, well, down round features have price protection only in one direction, right? So a down round feature, if the price drops, then the down round kicks in. But if the price goes up, then the down round doesn't come in. But fair value looks at things up and down. And so unfortunately, they were not getting an answer that made sense some of the time with the treatment that was happening. And so ASU 2017-11 has two parts, the part about down round features, and then there's going to be a part regarding a scope exception, which I'll deal with separately. So part one says if you have a down round feature, it is no longer going to preclude you from determining that something could be an equity instrument, right? So you're not going to have to say that it's no longer indexed to its own stock, and therefore you might get the scope exception, which means you might end up being a equity, which means you don't necessarily have to go through the whole fair value process you do with the liabilities. Now, it's not a guarantee because you still have to go through all of the steps related to classification, but it just changes the answer in one step and makes it a little bit easier and more likely for an entity to be able to get to equity accounting as opposed to liability accounting. Part two, on the other hand, takes what we call an indefinite deferral that was in topic 480, and it just makes it a scope exception. The impact is nothing because it was first just deferred, and now we're never going to do it. So the impact on practice is nothing. We've never done it. We never will, apparently. So if you're a public business entity, this will be effective for 2019. If everyone else, it'd be 2020. But if you do have these down round features, this is something I would definitely consider early adopting. ASU 2017-12 is related to hedge accounting. Now, for those of you who attended Michael's very well done webinar, and I saw the results and the evaluations that you guys gave him, and you seem to really like it, you'll know that it took him 50 minutes to cover this. I have about 2 to cover ASU 2017-02. So if you have hedge accounting, I highly recommend that you take some time and listen to Michael's webinar because he goes through all of the detail related to it. I'm going to give you a pretty high-level adjustment here. And so this is something that should look familiar because it came from Michael's webinar. I borrowed it when I created this one to talk about what are some of the items that we need to consider. So one of the things he talked about is that there is no such thing as ineffective anymore. So they took that term out of the master glossary. And if you are a cash flow hedge, all of it goes to OCI. If you're a fair value hedge, all of it goes to, oh, look, we have all these Hoos fans on the line. Yes, I'm a huge Michael Hoos fan myself. So yes, you can call him out and thank him for that awesome training. But the effective and ineffective portion either is going to go to OCI or to net income, depending on the type. It's no longer going to be between effective and ineffective. In addition, he talked about risk components. He gave an example of an entity that was going to hedge just a particular price for a particular input into a much bigger item, and that's now permitted. It was not permitted before. It does allow for hedging of non-benchmark interest rate if you have variable rate debt, not fixed, just variable rate debt allows for non-benchmark interest rates. However, if you had fixed rate debt, they added an additional benchmark rate, which was the SIFMA, which is great for those of you who are nonprofits on the room or who are investing in these nonprofits who are issuing these items. It also allows for a subsequent qualitative analysis, even if initially you had to do a quantitative analysis. And then one of the things that he talked about in other items that I am pretty passionate about is the requirements related to documentation and giving people more time instead of the documentation having to be contemporaneous. It could either be the first quarter if you are a public company or the first annual year if you are a private company, and to me that is really just fantastic. So as Michael taught you in December, this is effective for 2019 if you are a public business entity or 2020 if you are not. But remember, there was some early adoption options here. And so if you have this and you want some of them, those are things I would definitely look into. ASU 2017-13 is related to the SEC again. So remember, SEC is allowed to have their own guidance, and what they're looking for here is the fact that ASU 2014-09 really took away and all of the industry-specific guidance, but ASU 2014-09 and ASU 2016-02, which is for leases, have different effective dates if you are a public business entity or if you are all other entities, right? So we see that pretty frequently. If you're a public business entity, you have to follow a different effective date than everyone else. Well, one of the things about being a public business entity is that you can actually be a public business entity solely because your financial statements are included with another entity's filing. So you're not really a public business entity, but because you roll up somehow to an SEC filer, you become a public business entity, and therefore you are now stuck with a public entity deadline despite being a private company. And so a lot of people questioned whether that was fair for these large items like revenue recognition and leases, and the SEC kind of gave us a break here. And the SEC said that they would not object if you were a public business entity that would otherwise not be a public business entity except for the mere fact that you are being included in a financial statement of someone who did have to follow SEC, you would basically get the extra year like everyone else. And so they're saying here, if your only reason that you're doing this is because you roll up, then you can get the extra year, and so you would follow the effective dates for those periods. The next one is another SEC one, again, really focusing on ASU 2014-09. ASU 2014-09, which is revenue recognition, said no industry-specific guidance. Well, prior to this, SEC had issued guidance, 33-10403, SAB 116, all had provided industry-specific guidance that was particular to the SEC companies. And so basically what they do here is the SEC rescinds that guidance. So they remove things related to, and they're very bizarre small areas that you wouldn't even think about. One's related to vaccination. Another one's related to the strategic national stockpile. So really interesting areas. I had no idea. Bill and hold transactions, there's a whole section in topic 606 on that. So basically they take all the guidance that was specialized guidance for the SEC and they make it into they take it away so that you just follow topic 606, just like everyone else. And then our last ASU of the year is probably the least interesting for all of you. Nobody said that you worked with steamship entities. Shocking, I'm sure. But believe it or not, there is a section of the codification, topic 995, which is on U.S. steamship entities. Remember, the 900 section are all industry-specific guidance, and so there's industry guidance for U.S. steamship entities. And it has to do with deferred taxes that were made before December 15th of 1992. I don't even want to tell you what I was doing back in 1992. And so they said that this information probably is no longer relevant. And so basically ASU 2017-15 deletes this whole thing. So it supersedes all of this obsolete guidance on deferred taxes related to certain deposits because, one, it should be all phased out now based on the original effective date, and two, this is just sort of obsolete at this point. And so if you happen to be a steamship company, this might be of interest to you, but most of you don't really care, so it's 2019. So with that, that brings us to our last polling question of the day, and this one is just a question for you guys in terms of how many ASUs do you think FASB will issue in 2018? So they only issued 15 in 2017, but they have issued 22 in a year. They issued 20 the year before that. So they've had as, in the 20s, and they've had as low as in the teens. And some of you are scaring me. 2 is really optimistic. Whoever said 2, I am super duper impressed. For those of you who said too many, I can fully appreciate that. So we have some 18s, some 20s, some 15s. Oh, there's a lot. I'm going to actually broadcast these results so that you can kind of see what other people are thinking. 12, 7, 5, 25. Whoever said that, I hope not. That would keep me really, really busy this year. Let's see what else we have going. So you guys have had a lot of them. I think 4, 2 is now the lowest I've seen. A lot. Very, very accurate. Nobody has said 1. I was kind of hoping for that one, but I'll tell you that I know. Oh, there's my 1. 1 is not true. We already know that we expect a lot more than that. 25 is a little high, hopefully. I hope we don't have 25 this year. 48, oh my goodness. Let's hope not. I don't think I could handle that. All right, well, thank you guys for giving me that. I'm actually going to do a little bit of data analysis and see what your mean, median, and mode was. My daughter's studying that in school right now, so I thought she would appreciate some data analytics coming out of mean, median, and mode with some real data. So thank you for joining me. So that's it for our introduction to the overview of ASUs that were issued back in 2017 as we enter into the rest of the year. I want to wish you all a very, very happy new year, and I want you to have a fantastic 2018, and I hope to see you on what we have several webinars coming up throughout the year, so I hope you'll continue to join us, and I hope to see you on a future webinar. Thank you guys. You have my contact information should you have any questions, and I look forward to seeing you soon. Have a great day, guys. Bye-bye.